Money and Credit by Adya Bhardwaj, Role 3 from 10th C. Before going further, I want to thank my principal, my teachers, and especially Ms. Madhu for giving me this golden opportunity to make this presentation. Introduction. What is money? The root of all economics is trade, and the root of all trade is money. Any item that is generally accepted as payment for goods and repayment of debts is called money. Money is used in modern economy before barter system was used. To sum it up, we could say money is any item or verifiable record that is generally accepted as payment for goods and services and repayment of debts such as taxes in a particular country or socio-economic context. The main functions of money are distinguished as a medium of exchange, a unit of account, a store of value, and sometimes a standard of deferred payment. Any item or verifiable record that fulfills these functions can be considered as money. Before, commodities were used as money, but now nearly all money systems are based on fiat money. Fiat money, like any check or note of debt, is without use value as a physical commodity. It derives its value by being declared by a government to be legal tender. That is, it must be accepted as a form of payment within the boundaries of the country for all debts, public and private. A short note on traditional economy. Earlier, money did not exist. People used barter system in which goods were directly exchanged. Double coincidence of wants was an essential feature. It means that both the parties should agree to sell and buy each other's commodities. Simply put, what a person desires to sell is exactly what the other wishes to buy. The traditional economy does not exist anymore except in a few communities. These communities are small, primitive, and self sufficient rural communities which do not trade with the outside world. Now, money is in use in place of barter system as money eliminates the need for double coincidence of wants. It's interesting to note that in certain unusual circumstances, however, barter has resurfaced even in developed economies. During the severe financial crisis that hit Germany after World War II, the bankrupt country carried on trade with other countries through barter. Now let's take a look at the evolution of money through this picture. Barter began in Egypt in 9000 BC. Then, in 600 BC, the world's first coin was introduced in Lydia. The gold florin was introduced in 1250 AD in Florence, in Italy, in Europe. After that, in China, the first paper notes were introduced in 1290 AD. Then, in 1871, e-money was introduced. The introduction of e-money was followed by the introduction of credit cards, telephone banking, net banking, electronic money, and at last the introduction of Bitcoin in 2009, which led us to contactless economy. Here is a short summary of the beginnings of money. There are 5 stages of evolution of money: commodity money, metallic money, paper money, credit money, and plastic money. Money is a common thing used in exchange for purchasing goods and services. In ancient times, barter system was mostly prevalent in the world. This system started creating difficulties in trade as barter trade cannot be done between two individuals if one has need for something that another has, but the latter individual has no need of something that a former is offering. Thus, common things like shells, pebbles, salt came into existence as common goods used for exchange. This was the birth of money, and ancient economy started to develop. Commodities like these were used as money in the ancient times. Now, metallic money. As people started using commodity as a money, new problems came into being. Commodity money had 3 common defects: perishability, indivisibility, and heterogeneity. They were perishable, so couldn't be kept for a long time, and people couldn't repay their loans or they cannot save it for future needs. It was hardly divisible as commodities like coal, salt, etc. are useless if divided. So it was difficult to buy a product in a value which is half of currency's value. Different commodities were used in different markets or cities as a currency. That's why intercity trade was almost impossible. So ancient civilization devised metallic money to solve these problems. Metallic money was durable. It can be saved for a long time and can be used for future repayments or can be saved for future needs. People of ancient civilization manufactured coins in different metals to indicate different values. Gold coins were used for highest valuable goods, and so it can be divided into smaller values by exchanging gold coin for two silver or three bronze coins which have value smaller than gold coin. Paper money. As people started using metallic money, it was hardly portable. As trade and commerce increased, people started becoming rich, but it was virtually impossible to possess vast amount of coins as they were very heavy and bulky. So people during early medieval time in Far East started developing paper money, as paper is a material lighter than coins and so they could be carried easily from one place to another and the speed of trade would increase. Now people can possess vast amount of money. Credit money. As money became the household's main needs and greed overtook relationships in its importance, life was not safe and money had no protection from theft. To solve this, a banking system was developed. Through this system, people can save their earning in a given account and can ask loans for needs if they are poor. As moneylenders normally exploited poor people, banks took the responsibility to provide loans without having danger in their life. It is a systematic institution from which people can purchase goods or services by transferring money from their account to the seller's account easily by using an instrument named check. Any amount of money, high or low, can be transferred through check by writing that amount of money on it. Also, many governments have their own banks for saving and protecting public money, and this led to the control of flow of money in a country's economy. And thus, banking became the backbone of household as well as national economy. Now, plastic money. When digitization of information and data process started, banks took advantage and digitized their accounts. Also, the age of computer and internet created a favorable atmosphere for creating plastic money. Plastic money is of two types, credit card and debit card. ATMs started to develop and plastic money could be converted in cash through this machine. Plastic monies are type for transaction and nothing but transaction could be done. It has become a symbol of modernity. Modern shops ask for credit cards except from people who don't have it. Only bank balance could be transferred and not plastic card itself. It is portable, durable, and divisible. Thus, money has evolved and its evolution indicates economic development. Now, let's take a look at electronic money. Electronic money is currency that is stored in banking computer systems. Electronic money is backed by fiat currency, which distinguishes it from cryptocurrency. Various companies allow for transactions to be made with electronic money, such as Square and PayPal. Now let's take a look at cryptocurrency. Cryptocurrency is a new revolutionary type of currency. Like any other currency or unit of account, they only have value because people give it value. Cryptocurrencies were designed as a unit of exchange and as a place to store assets without relying on a central bank, thus cutting out the middle person with lower fees and faster transaction time. A move towards a more direct money transaction without having other people take a cut of your hard-earned cash. A cryptocurrency is a digital asset designed to work as a medium of exchange wherein individual coin ownership records are stored in a ledger existing in a form of computerized database using strong cryptography to secure transaction records, to control the creation of additional coins, and to verify the transfer of coin ownership. It typically does not exist in physical form like paper money and it is typically not issued by a central authority. Cryptocurrencies typically use decentralized control as opposed to centralized digital currency and central banking systems. When a cryptocurrency is minted or created prior to insurance to or issued by a single issuer, it is generally considered centralized. When implemented with this centralized control, each cryptocurrency works through distributed ledger technology, typically a blockchain that serves as a public financial transaction database. Bitcoin, first released as open source software in 2009, is the first decentralized cryptocurrency. Since the release of Bitcoin, over 6,000 altcoins, alternative variants of Bitcoins or other cryptocurrencies, have been created. Now, the functions of money. Someone has rightly said, money is a matter of functions for a medium, a measure, a standard, a store. Money is a great medium of exchange, a measure of value, a standard of deferred payment, and a store of value. A great medium of exchange. Why? Because it's light, small, and everyone will happily accept it in return for what they are selling to you or doing for you. Also, it's more convenient to carry money in your pocket than to cart a bunch of frisky goods to barter at the mall every time you go shopping. Money is a measure of value. Just like we have standard units to measure distance, time, weight, and temperature, money is the standard unit we use to measure the value of something. The more money you pay for something, the greater its value is. Money is given value by a country's government. Money is a standard of deferred payment. In plain English, that means money is an accepted way to pay off a loan, that is, pay someone back tomorrow for money they'll lend you today. Money is a store of value. It means that its value does not decrease over time, unless something like inflation occurs or demonetization happens. So now let's take a look on what is credit. Credit or loan refers to an agreement in which the lender supplies the borrower with money, goods, or services in return for the promise of future payment. It is an essential function or feature of money as earlier discussed. Credits can be from formal or informal sources. This can be taken either from the formal sector or from the informal sector. Formal sector includes banks and cooperatives, while informal sector includes money lenders, relatives, and friends. A poor person generally takes money or borrows money from a money lender because money lenders know them personally and do not demand any collateral. Collateral is an asset that the borrower owns, such as land, building, vehicle, livestock deposits with banks, and uses this as a guarantee to a lender until the loan is repaid. If the borrower fails to repay the loan, the lender has the right to sell their asset or collateral to obtain payment. Property, such as land titles, deposits with banks, livestock are some common examples of collateral used for borrowing. As a matter of fact, banks and cooperatives charge a much less amount of interest than money lenders, but poor persons prefer to go to them. Now, let's talk about the Reserve Bank of India. The Reserve Bank of India or RBI supervises the functioning of formal sources of loans, monitors the banks, collects information from the banks and lend them money. Reserve Bank of India RBI is the Central Bank of India. RBI was established on 1st April 1935 by the RBI Act 1934. Key functions of RBI are bankers bank, the custodian of foreign reserve, controller of credit, and to manage printing and supply of currency notes in the country. Reserve Bank of India is the central bank of the country. RBI is a statutory body. It is responsible for the printing of currency notes and managing the supply of money in the Indian economy. Initially, the ownership of almost all the share capital was in the hands of non-government shareholders. So, in order to prevent the centralization of the shares in few hands, the RBI was nationalized on January 1, 1949. Functions of Reserve Bank of India. Major functions of the RBI are as follows: issue of banknotes. The Reserve Bank of India has the sole right to issue currency notes except 1 rupee notes which are issued by the Ministry of Finance. Currency notes issued by the Reserve Bank of India are declared unlimited legal tender throughout the country. This concentration of notes issue function with the Reserve Bank has a number of advantages. It brings uniformity in notes issue. It makes possible effective state supervision. It is easier to control and regulate credit in accordance with the requirements in the economy, and it keeps faith of the public in the paper currency. Banker to government. As banker to the government, the Reserve Bank manages the banking needs of the government. It has to maintain and operate the government's deposit accounts. It collects receipts of funds and makes payments on behalf of the government. It represents the government of India as a member of the IMF, International Monetary Fund, and the World Bank. Custodian of cash reserves of commercial banks. The commercial banks hold deposits in the Reserve Bank, and the latter has the custody of the cash reserves of the commercial banks. Custodian of countries' foreign currency reserves. The Reserve Bank has the custody of the country's reserves of international currency, and this enables the Reserve Bank to deal with crises connected with adverse balance of payments position. Lender of last resort. The commercial banks approach the Reserve Bank in times of emergency to tide over financial difficulties, and the Reserve Bank comes to their rescue through it might charge a higher rate of interest. Central clearance and accounts settlement. Since commercial banks have their surplus cash reserve deposited in the Reserve Bank, it is easier to deal with each other and settle the claim of each on the other through bookkeeping entries in the books of the Reserve Bank. The clearing of accounts has now become an essential function of the Reserve Bank. Bankers Bank. The Reserve Bank performs the same function for the other commercial banks as the other banks ordinarily perform for their customers. RBI lends money to all the commercial banks of the country. Controller of credit. Since credit money forms the most important part of supply of money, and since the supply of money has important implications for economic stability, the importance of control of credit becomes obvious. Credit is controlled by the Reserve Bank in accordance with the economic priorities of the government. Functions of the RBI. Conclusion. Money replaced barter system and is evolving continuously. It has various forms and mainly 4 functions. Credit is very useful in daily life and has various sources. In India, currency notes and coins is printed by RBI. RBI also monitors how other commercial banks work and give loans. RBI has a variety of other functions too. Money is a very important aspect of our lives, and so is economics. It is often overlooked but is very fascinating. A closer look at how money functions and its various aspects can be beneficial in day-to-day life. Thanks for watching.